We head over to Sydney and Shane Oliver, Chief Economist and Head of Investment Strategy at AMP Capital Investors. Shane, thanks for joining us. Let's just talk about this super committee and a super failure here. What do you make of it all?
It's a sad day for America. I think it's just another example of how the political system in the US has become dysfunctional. Blind Freddie can tell you that getting the deficit under control over the next decade will require a combination of cutbacks in entitlements and some increases in taxes. So I think it's very disappointing that US politicians can't reach agreement. What I think is obviously is quite obvious.
Well, one of the best ways to get the deficit down is not necessarily to have these spending cuts and indeed, well, tax hikes. It's actually to get the economy growing. When we're getting some positive news, aren't we?
We certainly have been. Overnight we saw some better news out of the US in terms of existing home sales, and that basically continues the run we've seen over the last 6 weeks now, where the US data has surprised, if anything, on the upside. So it looks like the US economy is doing its part. It had that soft patch earlier in the year. It's now accelerating again, but the trouble is that the politics around that is quite terrible. And, of course, we've got the ongoing events in Europe, all of which, of course, are serving to drag down confidence on the share market.
Yeah, I mean, we get this bad news out of the US, but, I mean, the noise still rumbles on, doesn't it, when it comes to the Eurozone, too. We've got the possibility of a French downgrade as well. Now, that's weighing on sentiment, isn't it?
It certainly is. The reality is in Europe that if you go back 3 or 4 weeks ago, there was some hope that we might see some sort of respite given the announcement from the European Union, the response they come up with in late October. But of course that's all been blown apart by the events in Greece, then Italy, and now of course investors are back to being highly sceptical again. Obviously you've got this ongoing flow through to other countries, and I think the big problem over the last week is the extent to which the spreads have blown out in countries like France and even some of the other AAA rated countries in Europe, such as Finland and Austria, versus Germany. That's a real concern, and the reality is that as fiscal austerity continues, in the absence of much easier monetary policy conditions, that's just making the whole debt situation a lot worse. Investors now realise that, and of course they're pushing up bond yields in the countries being affected. So I think it's a major problem. There's going to be this ongoing cycle of fiscal austerity, worsening economic environment, causing more concerns about debt, more ratings downgrades, with Moody's alluding to the risk of that front in regards to France. So it's very hard at this stage, in the absence of an about turn by the European Central Bank, it's very hard to see the way out for Europe.
Well, what's actually been priced in now into the equity market, Shane? I mean, really, because we just keep on seeing this volatility.
I think there's no doubt the recession is priced in. When you look at valuation measures for global equities or US equities or European equities, they're all running well below historical averages, both in terms of price-to-book ratios, PE ratios, particularly so when you allow for very low bond yields, particularly in the US. So I think a very tough economic conditions already priced in, probably something approaching a global recession. I think, though, investors are worried that the situation in Europe will tip Europe in from a mild recession into a very deep recession, combined with some sort of financial crisis, and that in turn I guess is what's worrying investors at the moment, and that's why we've seen this resumption of share market falls. At this stage it wouldn't surprise me at all if we see shares go back to retesting the lows we saw back in early October.
All right, well, with that in mind, so the best bet is really at the moment in terms of asset allocation, keep the money under your mattress.
I think it's still a time to remain cautious. There's great value out there for long-term investors, and there may be, or there is a case for continued sort of averaging into the market. But I think for those who are worried about the short term and certainly worried about further falls in the very short term, it's still a time to remain pretty cautious.
Yeah, well, defensive is obviously one place, and a lot of people I've been talking to talking about, well, get into utilities, get into things which have a yield at least, and have a, you know, free cash flow, that sort of thing, and you're probably safe.
Well, you are safe to a degree. Mind you, even when you get into stocks which do have a decent yield, you can still see capital losses. I guess what they do, though, is provide a good buffer. Provided you've bought into stocks which are going to offer a sustainable yield, you don't want to get into stocks which are paying yield because they're relying on borrowings. But providing that yield is sustainable, then that provides a buffer in the event that shares might fall further in the short term. So I think that yield-based investing is definitely the way to go at the moment for investors who want to sort of keep a toe in the share market, but at the same time are still concerned about things.
Shane, thanks so much for that. Shane Oliver there joining us from AMP Capital Investors.